On today's hot sheet, I'm discussing weekly housing inventory data from Altos Research, Freddie Mac's November 2024 spotlight on the housing shortage, and a preview of this coming week's FOMC meeting, now in just 2 days away. Today is Monday, December 16th, 2024. I am Byron Lazine, and the hot sheet starts now. Okay, welcome into this hot sheet here as we're getting ready to close out December and close out 2024. We actually have a pretty packed week on the hot sheet. Of course, as we kick off every week, we'll get into inventory here shortly. We'll preview this FOMC meeting. It's Fed week this week, but there's a lot more to this week than just that. We have an NAHB home builder survey this week. I'll give you actually just my notes here of what this week looks like real quick. Right here on the screen, NAHB Home Builder Survey, mortgage applications, housing starts, of course, the FOMC meeting, the press conference. We're going to break that all down, extract every single dialogue as it relates to housing for you. We'll go over that on Thursday mornings. Hashi, we've got unemployment on Thursday as well as existing home sales happening Thursday, PCE on Friday. Of course, we won't have a Friday show. I will be back. Plan is right now. Don't hold me to it. Plan is I will be doing a hot sheet, of course, on Monday, December 23rd. So next week we should have a hot sheet. You know, we've got stuff at the end of the week. I'm hopeful we'll have an inventory report. So we should have enough for a December 23rd show. Of course, 24, 25. No show, but I'll give you all those housekeeping notes at the end of the week and beginning of next week as we get closer. The holiday week is next week, if you can believe it. This has been a very fast moving end of the year. All right, let's get into the fast moving inventory situation here on the U.S. housing market. The weekly change on inventory, according to Altos, fell from 690,000 plus to now just 682,000 on active listings, a little bit over 682,000. The same week last year, we ended at 538,000 and had a similar drop, about 8,000, which is exactly what we saw here this week. So interesting there that the drop is similar. We are at 27% more inventory at this time right now than we were last year. So much healthier place on inventory, well off of our peak at just under 740,000 here for the year on active listings. Active listings in 2015 at this time were over 1 million. So a long way to go if we want to get back to those levels, or even just, you know, what I would consider a more normal market like a 2019 where we're up over 800,000 at this point. 2017 up over, you know, about 840 and up over 850,000 in 2018. You know, just looking back the 3 years before, right before pre-pandemic levels, you know, it'd be a far stretch to get to 2015 with where we're at on inventory, of course. But if we can get back to 17, 18, and 19, I think everybody would take that. Certainly buyers would take that, as well as it being abundant more options on the market. 27%, again, more than last year, is heading in the right direction. How far will this go over the next couple of weeks is the question. Like, what's going to be the starting point that we enter January 1st with, hopeful to you know, that some of this inventory will hang on as we close out the year. As we look at new listing data, we did see that bounce back as expected. New listings came up to 45,000, just over 45,000 for the last week. In comparison to weeks prior, we're at 39,000 last year and 34,000 in 22. So the bump up after, you know, the Thanksgiving holiday week decline was expected. We did see that. You see last year, you do get a sharp increase the week after Thanksgiving. You know, the week after Thanksgiving in 23 saw 43,000. We're at 45,000. So still, you know, a little bit of a better bump. We do expect, as we've seen in almost every single year, as we get past that bump up shortly after Thanksgiving, the sharp decline to then ensue over the next couple of weeks. And, you know, you get as low as the last week of the year in the Last year was 24,000. 22 was 19,000. Hopefully we can beat those numbers here this year. But do expect new listings coming onto the market to start to really contract here over the next couple of weeks. Doesn't mean that listing interest is going to contract. Those conversations will continue for agents leading into January, of course. Price cut percentages were exactly in line with where we were last year at 38% at this time. 22, we saw 41%. So price cuts have stabilized even as inventory is higher than at any point during those 2 years. You're not seeing that reflect in prices. Sellers don't see, any need to, get their home to the market at a lower price than what they're expecting. They'll hang on, they'll hang in there, they'll go out there, next year. Look at now, if we look at something that we're going to be, paying attention to here this week, the mortgage purchase application index is going to, tell us kind of where we're at on demand. If we look here, really since September, we've seen positive year-over-year improvement coming off of the worst year really ever in 2023 on mortgage application index. We've seen the lowest level since 1995 on mortgage applications, but we are now seeing consistent improvement, and hopefully we'll continue to see that here throughout the end of the year, because that would enter into next year with some levels of momentum. Pending home sales are doing healthier right now than last year, 11% more single-family home sales in contract than last year, according to where we're at this week with Altos Research. All right, there's your inventory update. Of course, that's the macro. You should know the micro in your market better than anybody. Let the hot sheet show notes guide you on pulling out any of the fluff that you don't need to know in the macro and giving you exactly what you need. We do this every single day that we have a hot sheet, as well as all the charts. We have 8 charts uploaded into BAMX just off of that first segment on inventory, as well as the copy and paste notes for you to use in your communications inside of BAMX. We have a total of 14 charts on the day as we move into this housing shortage spotlight, as well as the FOMC preview and all of the hot sheet show notes, all inside of BAMX. Use code HOT to jump into BAMX platform today. Every week we deliver done for you content, as well as all of the notes and data that you can use on a daily basis from this hot sheet show note. All BAMX members get access to Zoodealio, which is providing you an advantage over any iBuyer in your market, partnering with you, not trying to eliminate you like those other iBuyers, as well as their home reports, which are helping agents get more listings in their market and separate themselves from the other agents that they're competing with. All right, let's move into Freddie Mac's economic, housing, and mortgage outlook for November 2024. The spotlight here is housing supply. Okay. Freddie Mac says the U.S. economy remains resilient with strong Q3 growth. The labor market moderates. We saw that the labor market definitely moderated last week. This could mean, if this continues here over the next couple of weeks, this could show us a reason why you might get a lower 30-year fix going into January. Haven't seen that here ending out last week. We're going to 30-year fixed just a minute. I mean, look at what the jobless claims last couple of weeks have done here. So we can continue to see that spiking. You would expect, as you did this time frame, you would expect that the 30-year fix 10-year should start dropping. So economy's been strong even as this labor market moderates. Recent volatility in mortgage rates have weighed on housing, of course, and mortgage activity. That's like a Jerome Powell line. The housing market continues to be plagued by shortage of housing units. And this is where the spotlight really hones in. Okay. Shortage of housing units for rent and for sale. Specifically, I would say biggest problem is for sale. We estimate that the national housing shortage is 3.7 million units in Q3 of 2024. So Fannie Mae has a number. It's 3.7 million units. You've seen other estimates anywhere between 2 and 7 million. Those are very vague. Fannie Mae kind of honing in on the middle there, 3.7 million units short of supply, according to their analysis, okay, in this report. So at least they're sticking to or putting a number on it. That to me, 7 million doesn't. I don't think if you put 7 million homes, on the active listing count that we just looked at right now, even if they're in an affordable price range, that those would be consumed just based on where we're at on affordability and the interest rates. So, 3.7 million seems probably a little bit closer to the reality to me. This is now slightly down from 3.8 million units in quarter four of 2020, according to Fannie Mae's outlook. Since quarter four in 2020, the U.S. housing stock has increased by 5.8 million units. Okay, that's an average of annual rate around 2.1 million units per year, according to Fannie Mae, on what we've actually added. Now, household formation over the same period, and this is right out of your hot sheet show notes inside of BAMX. You can use this, in your emails and all of that. Number of households grew by 6.3 million. Okay, so that's 2.3 million. And so we're a net negative 200,000 at minimum. And we were already short supply pre-2020. The target households increased by 6.9 million, annual rate of 2.5 million. So we're netting, not putting up enough housing units here. Housing costs, they've adjusted rents increased by 11% from 20 to 24, rising from $1,400 a month to $1,550 a month. According to Fannie Mae, latest demand, if rents were at 2,000 levels, the U.S. would have 1 million additional households, predominantly younger households. Okay, we would be forming more households if rents were at 2,000 levels. So that's just rents. Obviously, if you put, if you put into that, mortgage rates being lower, I think you'd also form more households, because there's obviously a lot of, of these young, soon to be households that want to buy, have a desire to buy. We've talked about this, quite a bit. In fact, CNN Business rather had a headline out this morning. This was published at 5:30 this morning. The median renter in America has a net worth of $10,400. The median homeowner's net worth is $400,000. I mean, this is what we're up against, right? Is this stat couldn't be more true today than ever before. And this is, as a real estate professional, this is what, you are trying to help your community solve. This is the knowledge gap that you're trying to close. The fact that, hey, yeah, it is cheaper to rent today. There's no question about it. But this is about as real as it gets in terms of what people's future are going to look like the longer they rent versus becoming a homeowner. There's no more stable way to, protect your future than home ownership. The median homeowner's net worth is $400,000 versus $10,000. And the stabilization of, just being able to buy down that 30-year fixed rate, even at 7%, which is like a historically average number there. Even at 7%, you're really doing yourself a huge service as you move forward for your shelter, fixing your shelter costs. And we know this, but this is the knowledge that we're trying to bring to our communities. And every single day, that's the good fight that you can obviously continue to make. Vacancy rates, going back to this Fannie Mae report, adjusted to 11.7%, down from 13%, reflecting stable market periods from quarter 194 to quarter four 2023. Actual vacancy at 10.1% in quarter three 2024, falling 1.6% below the target. Now, to me, when you see those numbers, like, what the heck? Why would there, when we have a housing shortage, why would that be? Well, one thing I think that the federal government could do to create inventory now, inventory is giving a tax holiday on, some of these second homes, some of these, where you get hit with capital gains and whatnot on selling a second home or an investment property. Give a tax holiday, you might see some of that market, some of that inventory come on to the market. Seasonal vacant, 2.8% of housing stock. In process of renting, selling is just 0.7%. Available rent or for sale, that makes up 3.6. We're just held off the market is 4.5. We want to get that 4.5% onto the market. Despite the addition of 5.8 million housing units since 2020, the shortage remains significant due to demand growth. And we're expected to continue to see that as we have a lot of young buyers and a lot of young folks who are homeowners now who want to sell it in order to buy something different. We went over that report last week on the hot sheet. Of course, you can find replays of the hot sheet right here on YouTube. Make sure you're subscribed to the channel. Please hit the subscribe and the notification bell if you're getting value from this show. But you can also find all of the hot sheet replays on Spotify and on Apple. If you listen on either of those platforms, please consider giving the hot sheet a review. It would mean a lot to us. All right, moving over to FOMC Fed Week. The previews are out. The conversations have started. What is the Fed going to do? More importantly, what is Jerome Powell going to say during his Wednesday 2 p.m. Eastern press conference, which we'll break down right here on the hot sheet Thursday morning? Most analysts right now expect the FOMC will cut the federal funds rate at the meeting this week by 25 bips, lowering the target range to 4.25% to 4.5%. Okay. That's the expectation. That was the expectation heading into the week. That remains the expectation on CME Group's dynamic graph reporting, where they have a 97% chance this morning, 97.1% chance that quarter point cut is going to happen. So there's really no doubt that as the FOMC meets here on tomorrow, Tuesday, and Wednesday, and do the press conference Wednesday, Jerome Powell's press conference, 2 p.m. Eastern, that there's going to be a cut. Now, there might be some dissents. Remember, 2 meetings ago when they cut a half point, you had one dissent out of 12. It wasn't unanimous. Last meeting, it was unanimous at 12. I'd expect maybe you have one or two maybe that don't agree with this cut. You might not get a unanimous decision, but it is pretty unanimous in the consensus throughout the market that there's going to be a cut here, moving forward with this meeting in this week. Now, B of A, what does Bank of America say? They expect the Fed to cut these rates here this week. Powell's likely to point to a slower pace of cuts thereafter, including a pause in January. Okay, this is a little bit uncommon when you see the Fed starting to cut. They usually consistently cut down to the level that they want to get to. But B of A is expecting that you will actually hear Powell on Wednesday talk about a slower pace that could scare the markets and even a pause coming in January during his press conference. Okay. The dot plot should show 3 cuts in 2025. Coming into 2024, we were expecting 7. We got 3. You could call it 4 because one was a half a point. But now we're expecting to extend that over a 2-year period, basically with 3 cuts in 2025. Remember, they're going to have 8 meetings or so in 2025. So only 3 of those are going to be a cut. 5 of those are going to be a pause. I think it's about 8. Can look that up in a second. Consistent with this, we think the macro forecast will indicate slightly stronger inflation next year. This is according to Bank of America, and higher, longer run growth. Policymakers won't account for the Trump agenda in their base case, but the balance of risk should give a sense of their assessment of potential policy changes. Okay, according to Bank of America there, how they're thinking about what the Fed's going to do here this week, of course, but also moving forward into 2025. If I go to FOMC meetings schedule real quick, just because I mentioned that, here's the schedule for 2025. You can find this at the federalreserve.gov. Of course, this is we're in 2024. That's over. So let's go to 2025. Here's the 2025 meetings. Our next meeting after this week is going to be January 28, 29. We have a March, a May, a June, and then a July, September, October, and December. So yeah, 8 meetings. I nailed that. 8 meetings next year, and Bank of America is only projecting 3 cuts. So yeah, you would expect January would be a pause if that's the case. If you're going to get 5 pauses, they're not saying, hey, maybe one's going to be an increase. We'd hate to see us going backwards at this point and have some type of an increase. But only 3 cuts out of 8 meetings would suggest that you're going to have a lot of pauses in there, of course, meaning 5. GDP projections of Federal Reserve here. The projection for GDP September's projection date. We'll get new projections on this meeting, by the way. Okay. So as the Fed projects forward, as they did in September, we're going to get updated ones here, this meeting. So we'll be looking forward to that as well. They're projecting 1.9 to 2.4 for this year, 2.1 for this year, but going next year on GDP, 1.8 to 2.2. Okay. Is the projection, and then 1.9 to 2.3. We'll see where the update comes in on that. Unemployment next year, September's projection was 4.2 to 4.5. We'll get an update on that as well. And then PCE inflation, 2.1 to 2.2. So September's projection was that number is going to continue to decline going to 25. We'll see how they feel about that on this meeting. Core inflation, 2.1 to 2.3. So another decline was the projection back in September, moving on a move forward basis versus what happened this year. And again, we'll see how they feel now on this December meeting. 10-year starting the week off at 4.395, dangerously close to a 4.4 level. Here's what the last 5 days look like, just an up and to the right run on the 10-year. That has impacted the 30-year fix. We closed out the week at 6.95. You could see a 7 handle this week. Could be a little bit of a bumpy road here on the Fed meeting week. The weekly came in at 6.6. So that was the best weekly we've seen in quite some time on the Freddie Mac 30-year fixed weekly. Probably not going to see that again this week unless we see a dramatic change. And that's your update on what's going on here for the Hot Sheet, your only place live on the internet every Monday through Thursday. Gives you a 24-hour look back on everything you need to know about housing for real estate professionals. Share the Hot Sheet, share the BAM YouTube channel with a real estate professional who can benefit from this type of 24-hour look back each and every single day. Use code HOT, of course, to get into BAMX today. Get access to the Zudilio platform with your BAMX membership. We'll be back here tomorrow during this Fed week, live 9:30 on the East, 6:30 on the West. Looking forward to being with you all then. Until then, of course, have a great rest of your Monday, and toodaloo.